retirement plan participants. On behalf of the whole team here at Kathmere Capital Management, I want to welcome you to our end of year 2022 market and investing update. My name is Kevin McDermott. I'm a principal here and a senior wealth advisor, plan advisor to some of the plans we service here at Kathmere. And on behalf of everyone, we are here twice a year to do these videos in an effort to help educate, in an effort to help provide some real insight into what is going on in markets and give some historical perspective as well on what's going on in markets, both equity markets, fixed income, and how you can best make decisions as you move on in your journey towards your goal of retirement. Also going to spend a couple minutes here just looking at what are things we should never forget as it relates to planning for retirement and saving for retirement. You know, what can and can we not control, et cetera. So let's get started. The first thing we want to consider about a retirement plan is why do we save now? Why do we save now? Why use your 401k plan? How much is enough to save? What's the right amount? And what type of investor are you? And how should that shape the way you use the options in your 401k plan? I think the first thing to understand, and this is a chart from our friends at JP Morgan that we use all the time, is when it comes to retirement planning, what are the things that you can control? What are the things that you have some control over? And then what are the things that are totally out of your control? And we know that one of the things that we can control is how we save and how we spend in our personal lives. And what behaviors can we help to change potentially to create some dollars that we can put towards a retirement goal? And we can also control how we invest, right? What choices do we make in our retirement plan or elsewhere to achieve our particular investment objectives? Well, what do we have some control over? Well, we have some control over, how we do at work, how much money we make, but not total control. And we need to sort of live within a budget and do what we can do on those topics. And then longevity, how long are we going to live? How long are we going to work? Tough to tell. What's totally out of our control, and we can't forget this, is the policy regarding taxation, policies regarding interest rates, which was definitely a theme of 2022. And then, of course, market returns, which is something we can't control. We can feel good about market returns over the long term, but we know that in the short term, we have no control over how stock markets and bond markets will perform. We always have to remember that the experts recommend that we save at least 10 to 15% of your income into a retirement plan. Part of that could come from your employer, but we live in a society now where pensions and Social Security for most people that go to work every day are not going to be enough to fund a retirement lifestyle. So we have to take the onus to save ourselves, and that's what's recommended to do if you're able. I think first thing that comes to mind on our ability to save is, well, if we're certainly saving, that's great. And are there ways we can save more? If we're not saving, what kind of strategies do people implement, and what are the impact by making these minor changes long-term in our retirement plan? So let's pretend that you didn't have a 55-cent candy bar every day, a $10 movie, or let's call it a $2.50 cup of coffee. I think the reality here is that if you look at what those savings can do long-term in your retirement plan, just by getting, 4% on your dollars, 8% on your dollars with the cost of those prices growing by 4%, this can make some very meaningful amounts long-term in your retirement plan. So you might not think that cup of coffee or that movie ticket or that candy bar makes a tremendous difference, but that little amount every day saved over 30 years can have a tremendous impact in your retirement plan. This is an age-old story, which we talk to people about, which is what over the long term is the correct strategy, the correct way to invest, and why is it so important to start early? So $200 saved monthly, there's someone we would call Nervous Noah that saved $200 a month for 40 years and saved quite a bit of money over that time. And for 2%, at a 2% rate of return, they saved a total of $96,000. Unfortunately, though, only because they achieved 2%, the value of the account only ended up to be $147,000, not because the person didn't save diligently, but because Noah invested in a manner that was overly cautious over a very long period of time. Quitter Quincy is someone who invests early in their working life from 25 to 35 and then stops. They only save $24,000 a year, but you can see that because they earned 6%, that $24,000 grew to $192,000, actually more than Nervous Noah, who saved far more over a longer period of time. But Quitter Quincy had her money work a little bit harder, to say the least, than Noah's did. Late Lydia didn't start at 25. She started at 35. She saved $72,000. She did earn 6%, but she actually only ended up with slightly more than Quitter Quincy, because Quitter Quincy started earlier and got that money working harder than Lydia, who saved $72,000 and not $24,000 by Quitter Quincy. Late Lydia ended up with $201,000, which is only slightly ahead of Quitter Quincy. Consistent Chloe is really who we all want to be, which is we save systematically over time and we get a solid rate of return because of the investments we chose over those 40 years. And she ended up with a nice nest egg of almost $400,000, $393,700. It's never too early to start. You know, you can see that Late Lydia waited a little bit, and it really cost her about almost $200,000 versus Chloe, because Chloe started at 25 and Lydia started at 35. It's really important to understand that, are you the type of person that reads the Wall Street Journal, watches CNBC? Do you want help in allocating your investments, or are you the type of person that wants to do it yourself? If you're the type of person that wants help, there's phenomenal options in your retirement plan called target date funds. If you picture a target date fund, and if you picture your retirement date, let's say you're 45 years old and you're going to retire around the year 2045. Instead of you picking the appropriate 10% in this fund, 20% in that fund, and then managing it along the way, that Target Retirement 2045 fund really puts you on an autopilot approach for the 20-some years you have from now until retirement. So not only does it allocate you in a prudent fashion for someone with that time frame to retirement, it also evolves with you as you move towards your retirement date. This has really been a godsend to the industry that has allowed people that don't understand finance to the extent that financial professionals do, to have a place to go in their retirement plan where they know they're investing like someone their age should, like someone with their time horizon should. Very important reminder, especially through the end of 2022. 2022 was a difficult year for both bonds and stocks. Everything in a 401k is in a mutual fund format, but this represents the S&P 500. And since before the Great Depression, the stock market has averaged about 10% per year, bonds about 5% per year. It's important to be reminded this year, always a premium to cash and to inflation over that very long period of time. There can be short periods of time where these numbers will be far off from what you see here. But for long-term investors, we need to understand what historically has produced the best returns long-term. This is something to understand too, is that although returns can be somewhat all over the place on a one-year basis, markets have performed very well over long periods of time. This is a snapshot of years when the market, the S&P 500 is really the 500 largest stocks on the US market. Think of Apple and Google and ExxonMobil and 3M and the like. And you can see that the overwhelming majority of the time, markets go up. Now, 2022 here, when the slide gets updated, is going to show a down year. We'll talk about that in a minute. But lest we forget long-term, what typically produces the best wealth accumulation strategy for clients and investors is to remain invested. Let's talk about markets a little bit. 2021 was a phenomenal year for the market. Seems like a long time ago. And it was actually the tail end of really a 10-plus year run in markets coming out of the global financial crisis of 08-09, where markets have done quite well. You can see that 2022 was quite a different story. S&P 500 down 18%. growth stocks harmed more than value stocks. Think of growth stocks as more of your technology companies, value stocks, more of your dividend payers, older type entities that have been around for a while. So it's something to keep in mind that when we go back to the previous slide, we know that markets have performed very well over long periods of time. We have to understand that, 2022 was a very challenging year. This is a longer term look, which I think is important. If you look and you looked at nothing other than what did markets do as of 2022, you'll see that it was a pretty horrific year for both stocks and bonds. I think it's important when you look out, though, at 5 and 10 years on US stocks, that even including a very poor year in 2022, for those of you that have been invested for 5 or 10 years, it's still been a great run for the growth of your dollars. And it's important to keep that in mind as we proceed. I'm going to talk a little bit in a minute about bonds and stocks and 2022 and what you can be thinking as an investor moving forward. This is something very critical. If you've watched the news, if you've read the papers, we certainly know it. If we've applied for a mortgage or tried to buy a car, interest rates have gone up dramatically and quickly in 2022. And the Fed has done that to fight inflation. Without going into too much detail, raising interest rates is a way to somewhat cool the economy and fight inflation, which was sort of starting to grip our economy. You can see that in different periods of time when interest rates have rose, they've typically been more gradual. You can see that maybe this yellow line in 2004 were rates rising fairly quickly, but nothing like 2022. That did have a negative impact on fixed income. So you might be looking at your investments and realize, well, I'm not even 100% stocks. Why did my account go down? And one of the reasons your account went down is because for the first time in a long time, bonds had a very poor performing year. The bad news is that it had a poor performing year. The good news is that when we look at bond performance, bonds have historically been a very, very safe investment for investors, both moving towards retirement and in retirement. And it's very likely that in the next couple of years, that coming off this year, that bonds actually perform very, very well. Yields are higher. You can see banks raising your interest. The ability to buy bonds these days and CDs, interest rates have gone up. If you have an allocation to this area that did very well, you should probably be thinking about staying put, because there is a likelihood the next couple of years that you're going to recapture much of those losses, if not all of it. When it comes to the equity markets, this is a very, very important reminder for us as investors. We show this with private clients. We're very excited to share it with you. As much as this 2022 column right here, minus 18% hurts in 2022, we cannot forget that the market since 1926 has averaged about 10% per year. About 73% of the time, markets have gone up. The reality is that last year was a bad year in the market. And if we look at some of these years where bad years have occurred, most of the time, the market recovers, not only ultimately, because ultimately every market has recovered, but it actually recovers quite quickly. So if you're the type of person that has invested and stayed disciplined, you should be somewhat excited about what the future holds, because you can see that the largest column in the history of our markets is markets gaining more than 20%. The second largest column is it gaining in between 12 and 20%. And I think it's always important to be reminded is that although markets average 10% per year over almost a century, it's very unlikely actually that you get near the average on one calendar year. The way to get 10% on average over a long period of time is to actually invest and save through all these environments. We certainly hope that years like these ones don't happen very often, but we know that if we invest through these years, that these years ultimately come as well, as they're the most prolific over the last 100 years. So I hope some of this has helped you as a 401k investor. 2023 has its challenges. I don't think all the problems of the world has been solved in 2022. But when you think about your investment strategy and you think about your time horizon to retirement, I think it's very important to consider what markets have done over the long term, how long you have till retirement, and what kind of risk tolerance and allocation is most appropriate for you. As always, if you have any questions, please contact your advisory team or directly contact our participant services department. Please ask for Grant Boyle. He's at 610-989-3900 at extension 112, or always send him an email. We are here to support you, help to educate you on this journey to retirement. We thank you for listening today. Have a great rest of your day and talk soon.